Good evening and welcome to today's market wrap. Let's start with the key numbers. The Nasdaq closed at 26,090 points, down 0.5%. The S&P 500 edged lower to 7,403, a drop of 0.07%. The Dow Jones Industrial Average bucked the trend, gaining 0.32% to close at 49,686. The VIX fear gauge fell back to 17.82. The 10-year Treasury yield climbed to 4.62%. The dollar index stood at 98.95. The offshore yuan traded near 6.79 against the greenback. Bitcoin fell nearly 2% to just above 77,000 USDT. In commodities, WTI crude oil settled at $102.45 a barrel. Spot gold remained elevated at $4,579 an ounce. Looking at sector performance, the strongest areas in China's A-share market today were coal mining, telecom services, and gas production. The weakest was the pork concept sector. In the U.S., semiconductor and memory chip stocks led the decline, along with precious metals equities. So what was the overall tone of the market today? In one word, it was a volatile and weak session, a classic case of shaking out weak hands. Money flowed out of high-valuation tech growth stocks. Some of it moved into traditional value names, like those in the Dow, some went into safe havens like gold, but the bulk of the capital simply chose to sit on the sidelines and hold cash. Let's walk through the global path of the day. Asian markets opened with caution. China's A-share market traded sideways on shrinking volume, failing to form a clear direction. Japan fell, Korea rose, and there was no unified risk appetite across the region. European markets tried to stage a rebound at the open, with major indices all moving higher, briefly boosted by rumors related to the US-Iran situation. But the rally was short-lived. Once US markets opened, they quickly became the turning point for global markets. The Nasdaq opened higher but then sold off sharply, extinguishing the hopes ignited by Europe. The rise in the 10-year Treasury yield was the direct cause, crushing tech stocks. The key inflection point today was the U.S. market open, led by the interest rate-sensitive Nasdaq. Europe was the sentiment leader but ended up being dragged down by the U.S. Now, here is a critical expectation gap. The market today completely ignored two bullish signals, the drop in the VIX and the decline in the dollar index. Normally, these two factors weakening is positive for risk assets. But today, the market paid them no attention. The pricing anchor was firmly locked onto the 10-year Treasury yield. This shows the market is extremely weak, and interest rate pressure is the absolute main theme in the current pricing system. Another important finding is that our earlier assumption of a broad-based sell-off was wrong. The Dow actually closed higher today, proving this is not a wholesale risk-off move, but a violent style rotation. Money is not leaving the market in large scale, it is reallocating internally, shifting from overvalued growth stocks to undervalued value stocks. This is a textbook signal, and it is likely to persist. Let's look at the three-way linkage between currencies, equities, and bonds. Today, the relationship showed a significant divergence. In the bond market, the 10-year yield rose, sending a tightening signal, which was the core negative. The stock market was severely divided, with the Nasdaq following bonds lower and the Dow moving independently higher. Meanwhile, the dollar index did not rise but fell instead, failing to resonate with the Treasury yield move. This divergence indicates confused market logic and huge disagreement between bulls and bears. A weaker dollar should normally relieve pressure on emerging markets, but the rising Treasury yield and weak tech stocks will put direct pressure on Asian tech sectors tomorrow. We expect China's A-share market to continue its structural divergence, with the Shanghai Composite likely outperforming the Chinex board. Finally, let's talk about the money flow and sector radar. The strongest capital direction today was traditional value stocks and defensive sectors, such as utilities and coal in the A-share market. The weakest direction was semiconductors and memory chips. The weakness in tech has persisted for several days and can be confirmed as a main trend. The strength in value stocks just emerged today and needs another 1 to 2 trading days to confirm its continuity. For now, we define it as a potential new main trend. The probability of semiconductor weakness is 85%. The driving logic is the rise in the 10-year Treasury yield, which directly compresses the valuation of high-growth sectors. Additionally, pessimistic comments from Seagate's CEO created a double hit from both fundamentals and macro factors. Traditional industrial stocks benefit from capital rotating out of tech. In a rising rate environment, their stable earnings and cash flow are more attractive. Gold strength has a 65% probability, supported by a weaker dollar and geopolitical uncertainty. For tomorrow, here are our core judgments. First, for the Asian market open, the A-share market will likely open lower, but will show significant style divergence during the session. The Shanghai 50 and CSI 300, representing value styles, may show resilience, while the Chi-Next and Star 50 indices will face heavy selling pressure. Second, after consecutive sell-offs, sentiment in the semiconductor sector has hit an ice point. If the 10-year Treasury yield sees a modest pullback tomorrow morning, for example, dropping back below 4.58%, this sector could see an intraday technical rebound window. But this is only a short-term trading opportunity, not a reversal signal, with a probability of just 40%. Third, tomorrow, we need to closely monitor any comments from Fed officials. The market is extremely sensitive to any statements about the rate path. Also, any new news from US-Iran negotiations could trigger violent swings in crude oil prices, which would in turn affect inflation expectations and market sentiment. Let's summarize today's self-iteration. Our morning forecast scores a 5 out of 10. What we got right was maintaining a bearish overall view, identifying high interest rates as the core driver, and anticipating continued pressure on tech stocks. Where we went wrong was misjudging the market's reaction pattern. We assumed a broad sell-off, but it was actually a structural rotation. We seriously underestimated the Dow's resilience and the market's ability to shift capital internally. Therefore, our future strategy model must add a style rotation factor. When judging macro negatives, we need to assess not only whether capital is flowing in or out of the market, but also where it is flowing within the market, such as between growth and value, large caps and small caps. The weight of the dollar index needs to be reduced at this stage, while the weight of interest rates should be raised to the highest level. Here are several verifiable predictions. First, in the A-share market tomorrow, the Chi-Next index will underperform the Shanghai Composite. The intraday difference in their daily percentage changes may exceed 0.5%, with a 70% probability. Second, the Philadelphia Semiconductor Index will continue its weak and volatile trend tomorrow, with a range of -2% to +0.5%, with a 65% probability. Third, the 10-year Treasury yield will continue to test upside resistance in the next 24 hours, possibly touching or briefly breaking above 4.65%, with a 60% probability. Fourth, gold will maintain a high-level consolidation in the next 24 hours, trading in a range between $4,550 and $4,600, with a 70% probability. Fifth, the ratio of the Dow Jones Industrial Average to the Nasdaq 100 will rise again tomorrow, meaning the relative strength of value over growth will continue, with a 75% probability. On the trading strategy front, the bias for tonight and tomorrow morning is hedging. Specifically, go long on a value stock ETF and short a growth stock ETF to capture the style rotation spread. The confidence level for this strategy is about 70%. If tomorrow in early Asian trading, tech stocks in both the A-share and Hong Kong markets generally open more than 1% lower, while value sectors like financials and energy show resilience, the rotation logic can be confirmed. However, if tech and value stocks move in tandem, rising and falling together without divergence, it would mean the market logic has shifted to a broad risk-on or risk-off mode, and the rotation thesis would be invalid. In that case, we should abandon the hedging strategy. The failure signal would be if the 10-year Treasury yield falls below 4.55% before the U.S. market opens, which would significantly relieve pressure on tech stocks. Our probability assessment for today's market is 10% for an up day, 35% for a sideways day, and 55% for a down day. The directional conclusion is clear: the market is undergoing a profound style shift, from tech growth to traditional value. Investors need to follow the capital flow and adjust their portfolio positioning accordingly. That wraps up today's market coverage. Thank you for watching.